In this video, we're going to talk about 1031 exchanges, how to perform them, how to plan them, and the top questions asked. How to do a 1031 exchange. Well, a 1031 is a tax plan to buy and sell real estate and be exempt of the gains from taxes. When you own property, usually you make money over time. That money can be taxed. Doing a 1031 exchange defers that tax so that you can move it into another property and not have tax consequences. How to begin. So we've talked about tax a couple times now. You need to have a tax plan. So before anything is done, whether it be selling real estate or buying real estate, you should have a game plan in place with your tax person before ever starting a 1031 process. Further, it should be your tax person that advises you to do a 1031 process. It'd be inappropriate for you to do this on your own. You should get the blessing from your tax person, from your tax attorney, that a 1031 makes sense for you. Too often, I see folks thinking that a 1031 exchange is the right fit for them. Then after they talk to their tax attorney, after they talk to their tax person, it actually is not necessary. So there's a lot of times when folks think that they need to protect taxes on real estate when actually they don't. So it's really, really important to have a full plan in place with your tax person before ever doing this. Let's slow down how a 1031 exchange works. So you purchase a property, say 10 years ago, and you paid $200,000 for that property. Now over 5 years, the market skyrockets. That property is now worth $500,000. You do not live in this home. This is an investment property. You're renting it out. Because remember, 1031 exchanges apply to investment properties. There's a whole nother set of rules for homes that you live in. So if you're living in the home for 2 of the last 5 years and it's deemed your primary residence, there's a whole nother set of rules about taxes and how gains work. So again, before you consider any of this, have a tax plan in place. What tools do you need for your tax person to build a plan? So first you need to know the current market value of your home. So do a market analysis. Could you use an appraiser? Sure, but if you're planning on selling and marketing your home, you can use a broker, a real estate agent, or a realtor and have a really good plan. Make sure that person provides you a current market value, what you can get in the open market. Also have them calculate all of the closing costs that it would take to sell your property so that you can see all of the closing costs as well as the net proceeds you will get after the sale of your investment property. Then take that sheet to your tax person, to your tax attorney, let them know that you're intending to sell this property and ask them, do you have tax consequences? If you don't, then you can sell, cash out the money and do it as you see fit. But if you do have tax consequences on the money that you made on your investment property, that's when a 1031 exchange program comes in, and your tax person would likely advise you to do so. And the purpose of it is to avoid paying the taxes on any money you make in real estate. Now for some, being a landlord is really hard, and they would prefer just to pay the taxes, get the cash out, and no longer be a landlord. But for many, it's a benefit for them to transfer money into another investment property. Maybe they're buying something larger. Maybe they're buying in a different area. We see this all the time in our market. In those cases, with the plan of your tax person, 1031 exchanges are a great fit. Commonly for us, we see this where there's states that there's investment properties where there's landlord laws that are very tough for a landlord, so they move it to states where there's lesser landlord laws, such as Nevada. Also, we see it when people want to upsize, buy larger investment properties. Maybe they have a duplex and they want to buy a fourplex. Maybe they have a fourplex and they want to buy a 10plex. We see this all the time. Other reasons is management. Maybe their rental property that they have is just too far away for them to take care of. So they choose to go to a closer location so they can keep a better eye on their investment. All of these changes, though, the underlying goal is to protect taxes on the gains of the real estate. So how does the process work? Basically, you sell an investment property and buy another. You do have to do so in a timely fashion. There are guidelines. You can buy and sell investment property at the same time, but there is a limit to how long you can wait. Once you complete the sale of your investment property, in today's guidelines, you have 45 days to find another property. This does not mean you have to complete the sale of the property in 45 days, but you need to be in contract on another property in 45 days. Now, there are exceptions to this. If you do find a property that isn't a fit and you end up canceling that transaction, there are stipulations of you being allowed to have more time to find another replacement property. Generally, it's about 180 days or the due date of your tax filing. We highly recommend every time a deal falls apart on a 1031 exchange to make sure you have a plan with your tax person before actually canceling that deal. So what we've done in the past is we're in contract, this property is no longer a fit. Before we cancel that contract, we have our clients talk to their tax person, build a plan on timeline so that they know the date that they have to go find another property. So it's really important to understand when it comes to dates in a 1031 exchange, you should not be receiving that advice from your real estate person. You should be in constant communication with your tax person and get the answers from them. Then give those instructions to your real estate person, and then your real estate person will perform on those. If you're purchasing through a 1031 exchange, is that bad for the seller? It is not. That money is sitting in a bank account, ready to be spent on real estate. It's just handled by a different person. We call that a facilitator, because the actual owner is not allowed to touch that money. It sits in a special account handled by a 1031 facilitator so that everything is in compliance with the taxes, but it's of no risk to the seller. We've used 1031 exchanges as down payments for purchases, and the buyer's still getting a loan. We've done 1031 exchanges as cash purchases, just same as a normal cash. The facilitator does not interrupt the process whatsoever, extremely easy to work with, runs in parallel over the overall real estate transaction, and we've always seen them close successfully without any issues. Think of it this way, if there's going to be complexities with a cash account, it's going to be the same complexities in a 1031 exchange. There's really nothing different between cash sitting in a person's personal account versus a 1031 exchange bank account. Can you do a 1031 exchange on a primary residence? Remember, there's a total different set of rules for a primary residence when you buy and sell. A lot of people think because your home has increased in value over the years that you're going to pay taxes. Now, there's a limit, but for most homeowners, there are no tax complications when selling a primary residence because there's special exemptions for those moving their primary residence into another, folks upsizing, those type of things. So remember, we're talking about 1031 exchanges. Think rental properties, properties you don't live in. Those are the homes that we're talking about that you can use in 1031 exchange programs. And remember, you're going to have a plan. So remember to take your sheet with proceeds over to your tax person. Tell them the property that it is. Tell them what you paid for. Tell them your plan of what you want to move it into and get their blessing. Because remember, they're going to be the one filing the tax return. So you want to do everything to their liking and then make sure that your real estate person follows those instructions. What happens when you sell a 1031 exchange property? So you've talked with your tax person, they've advised that 1031 is in your best interest. So now what happens is your real estate professional will coordinate what's called a facilitator. It's a third-party company who does nothing but handle the money of 1031 exchanges. Every realtor knows of a local company. We have two that we personally use regularly. And it's their job to facilitate everything. We make sure that the title company is aware that a 1031 exchange is going on, and we carry the sale as normal. The only difference is that we let the buyer know that there is a 1031 exchange occurring, but it's not going to cost the buyer any money and it will not complicate the sale whatsoever. The only difference is that when you go to sign your paperwork at the final sale, you'll have an extra stack of paperwork from the 1031 facilitator. This is special paperwork that allows you to participate in the program. Next, that money, instead of being transferred to your personal bank account, gets transferred to their bank account. They have a trust account that they're in charge of. By you not touching that money, it makes the money eligible for 1031 exchanges. You can use that money to go buy other property without the tax consequences of capital gains. Do you have to use all of the 1031 exchange money that you make off the property? The answer is no, you do not. Let's say you sell a property for $1 million. That $1 million goes into a 1031 exchange account. You choose to buy a property for $500,000. That money can be used for a 1031 exchange and receive those benefits. If you choose to take out the other $500,000 and not purchase property, then that would be taxed on a capital gains basis. So you would want to have that strategy planned with your tax person. If you sell a property for $1 million, you should have a plan in place of, I'm only going to use $500. I'm going to keep the other $500, and your tax person should be able to do a preliminary tax consequence so that you're fully prepared of that. I've had clients do that where they don't want to spend all the money and they're okay paying taxes on a portion of the sale, but they had their entire plan in place before ever considering this process, so there were no surprises. What is a reverse 1031 exchange? Now, in special programs, if you choose to participate, you can actually buy property with 1031 protections before selling yours. So the traditional way is you sell the property first, cash it out, whether it be concurrently, all at the same time, or maybe a little space in between. But other times you can actually buy the property first. then sell your property later. But it comes with special provisions. You can't just do this on your own. You need to be using a third-party specialist that does nothing but these. And you have to understand it's kind of like borrowing the money. So it's not like a cash exchange. There are fees because you're technically borrowing somebody else's money with a 1031 provision to protect yourself on the tax consequences. But it actually works sometimes. We've seen people that have opportunities that come up where they know it's a fantastic opportunity. It's worth the extra financing cost to do this special. It's kind of like a loan program, but it's not called that. It is technically a reverse 1031 exchange, but it's a great opportunity. They can lock up the property, secure the property, then sell the property later. So it's actually a backwards process. That's why they call it a reverse 1031 exchange. But you can't do it by yourself. You should be using a special company, just like you would if you were doing a traditional version with a facilitator. There are special companies out there that do reverse 1031 exchanges and keep it in compliance with tax rules. So it's another option to consider if you found an amazing property that you believe you would lose if you had to sell your property first. Think of it as like a non-contingent offer. So we use that term a lot. Contingent often for us means you have to sell a property to buy. A reverse 1031 exchange doesn't have to do that. You can use a special company's money to purchase, and then you replenish that money through the sale of the property later. Again, that's a special situation which has special extra costs. You should have your full plan in place with your tax person before ever considering that. What qualifies for a 1031 exchange? Real property. So land can be used, developed real estate can be used, and in some cases, you might be able to find some other tools and resources that qualify under the real estate category, but you'd want to talk with the limitations of your tax person, what is allowed and not. Now, as a scope of a real estate agent, we don't deal with anything besides raw land and real estate. So everything that we do when you own the land is eligible for 1031 exchanges. How long do you have to sell a 1031 exchange? You have indefinite. It doesn't matter because until you no longer own the property, you're not subject to any tax consequences. So it's until the property is out of your name does the tax implications kick in. So you can list a property today. It can take 5 years to sell it. It does not matter how long it takes to sell a 1031 exchange because in the government's eyes, you own it, you're just marketing it. When the tax implications kick in is when you no longer own it, when you've cashed out on it and liquidated it. That's when the timelines begin on a 1031 exchange. Big takeaways of a 1031 exchange program: you have to have a plan with your tax person first. Make sure you know the current market value of the property you want to sell, the closing costs that are going to incur, and the net proceeds that you're going to receive at the end of the sale. Take that to your tax person, build a plan before ever considering a 1031 exchange. Definitely don't do this on your own. Even if you do your own taxes, this is the moment where you want to have a conversation with a tax professional. I've seen folks make big mistakes trying to file their own tax returns in moments like these when you really should be having a professional set of eyes to help you build a plan. 1031 tax-deferred exchanges are not for primary residences. There's a whole nother set of rules and protections that apply when selling your home, even if you made money. Make sure you talk to your tax person about that. Almost all primary residence owners do not have tax consequences when they sell, even if they're making money. Last but not least, a 1031 exchange is not very complicated. It just involves an additional company that your real estate professional will coordinate or the title officer will coordinate. It just goes into a different account, a little bit of extra paperwork, and that's really it. The cash is really treated the same. It's not that complex to perform a 1031 exchange.